everyone, and welcome to Rock Report. Here we host commodity and market experts and company CEOs to give our audience a good foundation in their research with their due diligence. Nothing here is investing advice, and we advise you to look at our disclaimer before watching the video. Before I announce my guest, please take 5 seconds of your time and subscribe to our channel. We are pretty new, so every subscriber here is very welcome. And today's guest is a prominent figure in the mining investment sector, known for his work with juniorstocksreview.com. His expertise in resource stock investing, Mr. Brian Leni, thank you for joining us today.
Oh, thank you very much for having me.
Thank you. Your career, as I know, is pretty interesting. You transitioned from a professional engineering career to a full-time mining stock investing, notably after significant gains in, if I'm not mistaken, in 2015, 2016, something like that. What initially sparked your interest in the mining stocks, and what motivated you to make such a bold move by selling your home to invest in the sector? That's a brilliant story. I would like to hear more.
It's a brilliant story, and it's one that I look back on with it confirms the saying that ignorance is bliss. Because considering what I know now compared to back then, I truly knew nothing. But looking back, I was an engineer, like you said, in steel manufacturing out of school. Did that for about 10 years. Took a so-called promotion into management. So coming from process engineering, doing CapEx projects on the floor with the guys, and they're very much taking a step back and taking a managerial role, which is very different from a day-to-day basis. And it's something I didn't end up really enjoying. And at the same time, my wife and I started to have kids. And I was spending too much time at work, not being able to see them, and I wasn't enjoying it. And at the same time, I got introduced to this man called Doug Casey, and Doug Casey introduced me to the whole libertarian philosophy, which is something that I hold near and dear to my heart, but also the net effects of monetary policy and sort of what was happening in the world in terms of USD, Canadian dollar, and how that all worked in the financial system, and obviously saw the problems that were involved with it. And I got interested in precious metals, and so that's what I started buying first. And I think invariably when you start going down that rabbit hole, you somehow end up looking at junior resource companies. And unfortunately, and I say this unfortunately because it wasn't the best lesson to learn first, but the first investment I made into a junior resource company doubled. And as Rick Rule says, I confused a bull market with brains. This was in that just before the real height of the market, but it was very frothy, and I didn't even at that time really even realize why the company share price had doubled. But I just thought I must have done something or picked right. And over the next few years, I made some good decisions, some bad decisions, and that sort of led to 2013, where I really wanted to leave my job and decided to put some real money in the market by selling my house. And my engineering background has definitely made me analytical, and I took that dive with a good chunk of cash, and I ended up picking probably a handful of the best performing companies that eventually turned, like you said, in 2015, 2016, changed my life and changed the course of how I lived it.
That's really a brilliant story. I've done some due diligence on you prior of this interview, and your approach to resource stock investing emphasizes due diligence and emotional discipline. So, can you walk us through the core principles of your investment philosophy and how they guide your decision-making process?
Absolutely. So for me, like as an investor, it's how the basis of everything I do in terms of company picking is based around value and the value proposition of that individual company. And of course, that comes from a number of different things, but it starts for me mostly with doing a DCF or trying to understand the valuation of a company and comparing it to the price that the market's attributing to it. But it's not just DCF analysis. It's all those components. It's looking at the people. It's looking at their balance sheets. And it's basically how all those points come together to form a valuation. And then when you can find a company that's worth more than it's selling for, this is the perfect opportunity and what I look for, especially on the extreme end. If you look at some of the bigger positions I've taken over the last couple of years, they're focused on these companies that have a huge differential between their price to value ratio. And so this is where I've really focused. As an investor, the emotional side of things is something that is learned. I think if you're introspective, which I think I do a good job of being, and being real with myself and where I make mistakes and what my strengths are, I of course try to play to my strengths. But each year I make a concerted effort to try to fix some of my weakness. And it's not easy. It's not easy when it comes to emotions. The market goes up and down. But I think the more that I've been in this business, the more I've learned to temper both the highs and the lows and sort of stay in this medium ground where I don't get too blue sky in terms of where I think valuations are going, and I also don't get too gloomy after losses. And I've had a bunch of losses, but those losses have really shaped how I've directed the portfolio and directed my own money, and really those things have made me successful the last couple of years, and I think I know will make me successful into the future.
Yeah, the losses are the best school that you can get. I know that personally, so yes, agreed. Brian, what are the key factors you evaluate when assessing a junior mining company, and how do you weigh management, geology, and jurisdiction in your decisions?
For me, it's sort of cliche because I think you'll hear a number of people say it, but it does start with people for me. Continually, the people I've made money with are people that I've either invested in continually. One deal works, the next deal works, and this is sort of the lineage, and then sort of branches off those people. Sort of keeping a network tight, I think, is very important, especially if, and this isn't applicable necessarily to general retail investor. I don't know if you can necessarily gain the relationships that someone like myself would, but I think you can look at the people you've made money with and then look at how their connections are throughout the rest of the sector and sort of play that off in terms of maybe you don't know them as well, but you have made money with them and they're going to continue that same sort of mindset in whatever other company they're with and maybe what other company they touch in terms of, that 2 degrees or 1 degree of separation from themselves. So that is definitely at the top is those people. Good people pick good projects, they execute, and I think make return the best value per share to their investors over time. And again, these are things that I've learned personally from my losses but of course my gains. The other side to that, like I was saying about the valuation, that is very much a technical thing, a discounted cash flow model, and I tend to stick to things that I think better at understanding. And these are companies with at least a resource or a technical study that I can put my own numbers to and sort of take their list of catalysts, whether it be drilling or metallurgical study or something like this, and apply it to my model and see where that valuation might go if they're successful. And then, of course, the better I know management and who they're involving to either pick those drill targets or do those met studies, then I have a confidence level in terms of how that's going to execute in my DCF. So forming that valuation, I think, is key to me, not only evaluating where the company is now, but where it's going. And of course, knowing where it's going or could go is part of the battle, because selling is just as important, or selling rate is just as important as buying rate. And again, this is something that came later to me. It's one of the I still have tons to learn, but this is one of the later things that I learned, how important selling is. And of course, you can't sell right unless you know what a company's actually worth.
Yeah, definitely. Great overview, but I would like to ask you more about the timing. Can you share your methodology of identifying optimal times to buy or sell? And how do you balance technical analysis with market sentiment? And
Sure.
what's the mix here?
Yeah, so I guess there's a few different cycles. Like I see the market cycle and I see the metal cycle. And so the metal cycle is that overall kind of path or momentum in the resource sector in general. And then you've got each individual metal sort of has its own cycle that it's going through, both bull markets and bear markets. And one always precede or always comes after the other. Like as Rick Rule says, is a bear market is the author of a bull market and vice versa. And so when you're investing, these are simple things that you can sort of identify, and it's usually related. It's at least at the metal level, it's related to metal price. If you see that the metal price is at all-time lows, that interest in the companies are at all-time lows, you're obviously in the bear portion of the cycle, and as such, you're probably taking a contrarian bet if you're investing in one of those companies, and vice versa in the bull. For me, I like to do sort of two things. I don't like to bet and pretend that I know where a metal price is going. I think that's how you lose money fairly quickly in this sector, because nobody that I've met has actually been able to do it with any consistency. So I like to invest when it's obvious. Precious metals, I would say gold right now. It's a pretty obvious bet that we're in the at least in the early stages of a bull market, and that the differential in the valuations should catch up to the metal price at some point. So I love those bets where to me it's not even really a bet. It's sort of an obvious thing. Outside of that, I like to put money into companies that don't require a metal price or a market cycle to be with them. And these are obviously huge differentials in valuation. And again, this plays into the fact with understanding what a company is worth and what those catalysts are that they are going to have to garner market recognition. Because this is the thing: is a company can be undervalued, and there's a number of companies out there that are undervalued. But where's the interest from the market going to come? So if you can understand those things, and of course see how the market is going to gain that interest, then you can capitalize on these differentials. And again, if you look at my portfolio right now, how it's balanced between exploration and development, I would say you see more than half of those companies do not rely on the market cycle or the metal cycle for you to make money. And last year, the portfolio returned really well, and it was directly correlated to that.
How is your portfolio actually between the developers and producers and the juniors exploration plays? How are you? What is the ratio between those three?
That's a good question. I would say it's probably right now we do have a producer. It was a great story. It was G Mining who transitioned from a developer into basically a mid-tier producer that's got a long pathway, I think, to becoming something much bigger. They're the only producer, and I typically don't buy a lot of the larger companies, and but G Mining is a special case. Other than that, I would say it's probably around 50-50 between developers and I wouldn't say necessarily it's full exploration. I like to concentrate on prospect generation, meaning companies that are basically high geological acumen. They have a good technical team. They form projects, and then they look to JV those projects to people with larger pocketbooks, big treasuries, meaning the senior mining companies. And I think the companies that do those exceptionally well stand out from the crowd. And again, if you look at the portfolio again, that those probably represent. There's 13 companies in the portfolio. There's probably 6 that are prospect generation, and then 1 that is like a sole exploration company. And oddly enough, that's the one that's had the most trouble in terms of maintaining valuation.
Yeah, prospect generators are a good bet, especially in the times when when they have troubles raising money, and sometimes juniors and explorers have troubles raising money. Of course, depends on the commodity if it's hot or not, but nevertheless, when it comes to the commodities, how is your portfolio structured there? So the majority is gold. Do you have other investments, silver, copper, uranium? How is that
Right.
looking?
Yeah. So yeah, the focus definitely is gold right now. To me, I think that's the obvious play, and where it's most likely you're going to make money based on metal price appreciation. Next to that, I am agnostic to the metal. I'll invest in whatever I think I can understand, and where there's a differential in value. Right now, there's exposure to precious metals, copper, nickel. And up until last year, I did have some oil exposure. That investment didn't end up working out. But in terms of energy, that's what I had exposure to. But basically, yeah, it's 3 main metal sources right now, for very specific reasons. And like I said, I would invest in just about anything if I think that the valuation is correct, outside of where I think the metal price might be headed. And that's where I've seen the most opportunity.
Sure. Copper, uranium, you don't have them?
I have copper. I do have copper. I don't have uranium right now. Uranium is something that I missed that initial bump. And it's quite funny because one of the first things I invested in fully was uranium back in about 2017. And I wrote this big report, and I made some investments, and the uranium kind of popped and then came back. And I was pretty disappointed with where those investments came. And then of course, what I think it makes you is sort of gun shy. If you believe past is prologue, this is another downfall of losses if you don't necessarily learn from them correctly. I definitely leaned towards not believing in uranium when a lot of the uranium bugs were sort of pumping it in 2022, 2023, and then it had a fantastic move, and the uranium price moves threefold, and I missed it. And so looking at it today, I'm not sure that I see a ton of value in the uranium juniors. I've certainly looked. I think that depending on the story, if you're playing exploration, obviously an exploration company can pay you wherever you are in the cycle. But for the developers, I'm not sure that I've been able to find a differential that I'm comfortable with taking, especially when you compare it. And this is usually what I do is compare it to the rest of my portfolio. And I look at something like gold, and to me, it's much more obvious, and the differential I think is still there and good enough that I would rather have the money in that right now than to take that contrarian bet. And I don't even know if it's certainly not a contrarian bet. I think uranium's going to be around for a long time and be meaningful. Just right now, I think the opportunities, or the way I see them, are more focused on gold.
Okay, yes, gold is in upward trajectory, as we know. However, we are living in the volatile times, in the volatile markets, especially general markets. You never know what's going to happen tomorrow or the day after. So, what strategies do you recommend for investors to manage their emotions and stay disciplined during market downturns or euphoric upswings?
You know what? I would say mostly ignore news flow. I think again, if you take and my strategy has been this, it's not always easy to ignore the noise that is spouted out about, conflicts around the world and how that might affect your portfolio, is to basically pretend like it doesn't exist to a degree and move forward with investing in companies, because you can't predict the future. The complexity of world events is so complex that I don't know how anybody can really truly understand it and how it trickles down. So you make investments based off the primary fundamentals, like the stuff I was talking about. You plot through, you try to avoid making metal price prognostications and find those companies that have catalysts that'll garner market attention, sort of regardless of where that metal price goes, within reason. And you invest like that, and then huge drops, like huge crashes in the market, let's say 2008 or 2020. To me, those are absolute opportunities to buy. I've really benefited from some mentors in my life, and I would say going back to 2020 when that COVID crash happened, I remember there was 3 days where you had some really discernible drops in the market. And it was funny, just prior to that, I remember sitting at PDAC with one of my mentors and a very good personal friend. And he said to me,
Feel
"What?"
free to name them.
So it was a friend, Giant Bandari, and he said to me, he said, what does it matter if the world is falling apart? What does it matter if my money is in my bank or sitting at home or in the stock market?" And I thought about, like, that's the genius, and it takes a certain mind, it takes a certain mindset to sort of deploy it when things are going crazy. But I was so happy I took it to heart, and I put it into action. And that money I made in 2020 was the best financial year I've had to date. Now I think whatever's ahead, I think, is going to be much bigger. It seems like where we're headed, where metal prices and where demand is going to go, I think we're in this sort of sweet spot. And I'm a lot smarter than I was in 2020.
Of
So
course.
I've got the better tools to equip myself. But looking back on that, that was the opportunity to deploy into, and that sage advice from Giant helped me so much. So those big like deflections in price are absolute opportunity in my
And
opinion.
you don't have to sell any more houses, right?
No, no, I will not be doing that again. So I think that's definitely a one-time occurrence in my life, and I don't think, while I had the support of my wife back then, I don't think she would go for that again. And again, like I said, looking back on that, ignorance truly is bliss. And
Yeah,
but
agreed.
but what I'll say is this: is
It
again
comes
another
with
thing.
age.
Yeah, absolutely. But I'll say this, and I think people have told me that my stories inspired them, and I truly hope that it does inspire people. but it doesn't necessarily have to be in the investing world. I think people need to take calculated risk in their life. If you want to make a difference, if you want to change your life, if you want to do something different with your life, you have to take some calculated risk and be willing to accept those consequences if it doesn't work out. And bottom line is, don't give up. And like those have been so key to my success. Well, I was definitely lucky in picking a handful of good stocks back in 2016. I've had to persevere. And again, I think you can parlay my experience and what I'm saying to any aspect of your life.
Yeah, you are definitely a risk taker. You often focus on a low market cap mining stocks for their speculative potential. What are the risks and rewards of investing in these smaller companies? Those are nano caps. And how do you mitigate the inherent uncertainties?
So starting with the risks are that you lose. I would essentially you have to be comfortable, I think, with losing everything. And the reason why I say that is you might only lose 50% in the share price, but typically these lower market cap companies have no liquidity, meaning that the share price dropped, you still have 50% of your money, but you have no one to sell it to. And so this becomes something you have to sort of plan for, both on the buy side and the sell side. But talking on the downside, the risk is that can be the situation. So mentally you need to be prepared. One thing I think that people need to be mindful of is that a lot of people think that they love risk and that they'll do this, they'll do that, but they don't understand the impact of a loss and what that actually does to you. And the psychological thing I've read is that losses are much harder to your psychology than gains in terms of their up and down. And I would attest to this. And I hope people can listen to this and say, hey, look, I probably need to get in this sector and start buying and selling and see how I react, because I'm going to make mistakes. We all do, and see how that reflects. And then you'll have a true idea of what that risk is and what it feels like to receive it. Other than risk, there's a bunch of different sources. You yourself will be your biggest risk to your money. How you deploy it, all the emotional stuff, those things will be your hardest thing to overcome. Next to that, again, you have the risk in the liquidity. You have political risk. Every jurisdiction, in my view, whether it's Canada and the States, which are probably synonymous with being tier one jurisdictions, compared to parts of Africa or the Congo, which could be probably considered your bottom of the line, each has their own individual risks to your money. And you can talk to the likes of Altius Minerals, who lost or potentially had lost $220 million to the Alberta government due to carbon, some changes in carbon taxes, which restricted one of their royalties out into the future. And so like you can lose money so many different ways in the junior resource sector. And that's the reality of it. And I think you can't really comprehend that till you get into it. On the upside though,
Yeah.
you have what I've experienced into, if you do it right, you have the opportunity to change your life in terms of the gains that you can return. They truly can be remarkable. If you can align a good pick with a bull market, you can truly change your life. That double in share price in a normal year can be a 3 or a 4 or 5 bagger quite easily in a bull market, and that's just the reality. But the reality also is there's far more years where the market is dead, meaning like horizontal or down. And so you have to be able to deal with those sorts of markets until you get to the bull cycle. And what I've often said to my readers is that the bottom line, I think, for in terms of this, using this as a learning experience is lasting, making it to a bull cycle so you can experience that. I think a lot of people want to get too aggressive, or they don't have the staying power. Like when I sold my house and I put that money into the market, I saw my, 2/3 of my net worth go down by 35% in the preceding 3 years. But I had to have a long-term view to sort of get there. And I guess my psychology and maybe my backdrop, like if I lost that money, I wasn't going to be destitute. But the whole point was making it to the point where you hit that bull market, and then those good picks that you had, even though they went down at first, they were the first ones to sort of move, and I made that money. So that would be on the reward side, but your mentality and how you're going to operate in the sector has to be aligned with how the sector works, and it's not instantaneous. And while gold may seem like the most probable place to make money, that doesn't mean that's what's ahead. There is definitely a scenario where it doesn't work out. So
Yeah, all good points. Let's address a little bit more of the red flags when doing a due diligence. You addressed the issue of stock warrant overhangs in the mining companies, as I remember. That and what are the some other red flags that really keep you away from investing in one company when you are doing a research due diligence on the company?
share structure is a major thing, and the warrant overhang I've experienced a few different times and have had to learn from how important it is to look at a share structure, particularly the warrants that are out into the future and what that might do to the share price. So you can be right about a junior resource company. Maybe they make a discovery or their catalyst hit, the share price starts to move up. But let's say it's trading at $1 and you have warrants at $1.20 and $1.40. That share price, or you said that with these catalysts come to fruition, the share price should go up to $2 and everything sort of aligns. But the problem is you have those two overhangs of warrants at $1.20 and $1.40. What can usually happen is that as the share price goes up, those warrants are exercised, and of course a bunch of liquidity hits the market. And it's good that it hits it in an upswing, but it caps it. Maybe that share price doesn't hit $2. Maybe it gets capped at $1.50, just because all of that selling from those prior private placements filtered into the market for profits. That maybe those aren't the best levels to sort of project, but it's the whole idea that the warrant overhang can act as a cap to the share price. And considering the risk that's involved, especially if this is a discovery play, you're taking a huge amount of risk for probably a restricted amount of return because of the warrant overhang. And I've seen a number of instances where this has come to fruition, or people will avoid the stock because of the large warrant overhang. Next to that, what was the rest of the part of the question?
I mean, the red flags, general
Oh,
red
red flag.
flags that keeps you away from investing in a company.
So the other thing, and it kind of flows in with share structure, is the alignment between management and shareholders. Meaning, how many cheap shares, or what is the average share price of the management team in comparison to where you're entering the stock. Especially if this is a new issue, this is something you really want to look at. RTO, IPO. Where is management compared to you on that brand new company? That especially sort of separates the wheat from the chaff. If these guys are already sitting on a 5-bagger or a 10 bagger, meaning 10 times their money, and they're going public right now, to me, that's problematic. You want to be investing as close to where management has their position as possible. You want to make sure that their interest is to push this company forward basically as quickly as possible within reason. They want to take the right steps to move it forward and not be willing to just sit there on your 10 bagger and wait for things, collect your salary. So you want alignment between management and shareholders. So again, new issuers, this is especially important, but I think it should be one of your first questions you ask any junior company is sort of asking the CEO, where is his position? Next to that, I think excessive promotion. Promotion is very much needed. Junior resource companies need to get out there. They need to tell their story. And I think they need to do it on a number of different platforms. But if your promotional budget is the same as your drilling budget or your exploration budget, I think you have a real problem. And eventually these companies, they're either set up from the very beginning to be basically lifestyle companies, or to help shareholders that aren't insiders blow out shares into the market. Eventually these companies will be all the value will be destroyed because they will spend too much money on promotion. If it's not maintained by good or successful development from the company, it comes right back down. And in fact, there becomes a stench that gets associated with the company when you have those sorts of stock charts, because there's a lot of people that bought on that upswing with the promotion and obviously got left as bag holders. And this is really what has been a problem, I would say, in the junior sector, is that there's been too many of those in relation to successes. And hopefully that changes. Hopefully people can just avoid those right off the hop and listen to whatever I'm saying and take heed read to it, and do some due diligence before you just go out and buy whatever is being promoted out there. Definitely want to learn about different companies through interviews and whatever, but do some due diligence and see how these guys are spending their money and make sure that the focus is actually on money in the ground versus mining the market.
Yeah, due diligence is the key, but sometimes people do not do it. They actually they have a minimum of due diligence and they buy stocks like lottery tickets. So that is a very often thing I see. Brian, through your platform, you share insights and educate investors. How has running this platform influenced your own investing process? And what do you hope to achieve for your audience in a long term?
So the newsletter is a direct reflection, like the newsletter portfolio is a direct reflection of my personal portfolio. And I think that is probably the best case that a reader or subscriber could want. I'm fully aligned with them in terms of when I take a position, when I sell a position, all of that is disclosed, and it's a really good alignment. Next to that, I would say the newsletter really has become something that not only gives me an anchor in terms of ensuring that I'm not only doing the best for myself, but doing the best for my readers. And writing that article and having to explain to somebody else through the written word why I think investing in this company is smart or something that should be done, and what strategy that we're going to take to extract as much profit as possible has only done me good. I'm one of those people that I crystallize my investment thesis through the writing process and through explaining it. The more times I talk about it, the more times that I write about it, the more it crystallizes exactly what I need to be looking for and what I need to do in terms of extracting the most profit for the newsletter for myself. And so that has been phenomenal. In terms of my goals, obviously, the newsletter is there to make me a little bit of money too. And that's an obvious goal. And I will admit that.
It's okay.
And secondly, though, and I've been super proud of this, is the fact that I've been able to have people. My newsletter's been around for, this is the 5th year. I've had guys that have been with me for a couple of years, learned, asked me a ton of questions, and now have gone out on their own, and I still have contact with them, and that brings me a huge amount of joy knowing that I've been a part of helping this person achieve independence as an investor in the sector. And they continually, it's funny because I had an interaction with a former subscriber, and it was funny because we had gone into the same company sort of around the same time, him just after me. And I thought, oh, wow, he is using what I taught through the newsletter and applied it to the sector, and ended up finding a company that attracted me too. And that brings me a tremendous amount of joy. And I know that'll be the way it goes forward for those that want it. That those that want to use the newsletter as an educational source, as me as an educational source. I'm here, and you can gain from my experience.
Excellent. I left the hardest question for the end. You have to name me 10 people from the investing or commodity world that you respect the most and the advices you listen. Okay, we know one, Rick Rule. You have to name me 9 more.
Jaime Bundari, David Lotan, Pierre Lassonde.
That's 4.
That's four. I really like Chris McIntosh, the Capitalist Exploits. I think I'm going to forget people here too. I think Joe Mazumdar does a great
Yeah,
job.
agreed.
Brent Cook, new and upcomer that I've been exposed to and traded some emails. I think Vuk
Pekovic.
Picture, yes. I think he's great.
He works
Brian
for
Lend-
Lobo Tigre, so you like Lobo as well, right?
I don't know Lobo as well. I've just been exposed to Vuk via Twitter and then through the exchanges that we've had via email, and I think he's definitely doing very well.
2 more.
2 more. Brian London, I've he's a friend. I've grown to really like and respect. And I apologize whoever else I'm forgetting here. And I've got one more, right? And a good friend of mine, Bill Powers, who does mining stock education. Super close with him, and think he has a tremendous amount of value to bring to people.
Yeah, you go way along with him, if I remember.
Yes, absolutely.
Yeah, that's great. Brian, how can investors, people reach out to you and become your subscribers?
So first, they can go to juniorstockreview.com. There, you'll find some of my general public articles I've written, and of course, my subscription service, which is gives a, both a quarterly and yearly option. You can follow me on Twitter at junior_stock, and of course, there's also LinkedIn too, where you can just search my name, and if you want to follow me on that, I'd be happy to, or connect. I'm happy to connect via
Yeah,
that.
that was Brian Leni, founder of juniorstockreview.com and the main boss over there. Brian, thank you for joining me today. It was a great chat.
It's been a pleasure. Thank you.